A few weeks ago, I was reviewing my balance sheet. Not the headlines, just my own numbers. And I realized something uncomfortable. It wasn't about my returns, it was about my structure. For years, I believed my financial plan was robust. But 2026 forced me to ask a question I hadn't asked in years, and the answer was not what I expected. That answer uncovered a significant vulnerability in my financial plan that had nothing to do with my investment returns or picking the right stocks. It was a structural issue I had overlooked. In this video, I'll walk you through the flaw I discovered and the simple but important shift in perspective that has fundamentally changed how I approach my financial security. On paper, everything looked right. 6 months of expenses in cash, diversified across stocks, bonds, and alternatives, focused on long-term growth, optimized for returns. Nearly every financial decision was filtered through the question, how can I get the highest possible return for this dollar? The idea of holding excess cash felt like a missed opportunity against the power of compound interest. I had spreadsheets and charts that mathematically confirmed I was on track to hit my long-term goals. This system gave me a strong sense of security. It was a belief that I had engineered a plan that could weather uncertainty. Recessions would come and go, but the core strategy was built for the long game. I wasn't just secure, I was comfortable. And as I was about to find out, comfort can lead to complacency. The shift in my thinking began gradually. It wasn't triggered by a market crash or a personal job loss, but by a subtle change in the economic climate. The environment felt tighter. While inflation had cooled to 2.4% in January, the memory of recent price volatility remained. The cost of money had changed. The data point that caught my attention was the interest rate on mortgages. It served as a personal barometer for the cost of money. As of mid-February 2026, Freddie Mac reported the average 30-year fixed mortgage rate at 6.09%. Whether you have a mortgage or not, that number is a signal that the cost of money is different now. One evening, while reviewing my portfolio, I couldn't shake this feeling that the underlying rules had shifted. This prompted me to finally confront a question I had been avoiding. The question was, if my income dropped and the market fell 30% at the same time, would I be forced to sell? It's a plausible combination of a personal cash flow issue and a market downturn, which often occur together during a recession. I ran the numbers, considering my 6-month emergency fund against my monthly expenses and a portfolio with a hypothetical 30% decline. The conclusion was clear. The answer was yes, and I didn't like that. Not because the math was wrong, the math was fine, but because I realized I had been a little overconfident. I had optimized for growth without fully optimizing for durability. That was on me. I would be forced to sell. I would have to liquidate growth assets at the worst possible time, in a market downturn, simply to pay my bills. My careful diversification and focus on long-term returns would be compromised by a short-term cash crunch. This realization caused me to reevaluate my entire approach. How had I overlooked such a fundamental risk? I had spent countless hours studying investing and asset allocation, but had missed a critical piece of the puzzle. The flaw wasn't in my choice of investments. The flaw was in my positioning. My strategy was built entirely for offense, for growth and accumulation. It was an effective fair-weather strategy. However, it lacked an adequate defensive component. The structure I thought was so resilient had a clear point of vulnerability. Here was the issue. I had mentally earmarked my investment portfolio as a source of liquidity. I assumed that if I ever needed a large amount of cash, I could simply sell some assets. But I never fully considered the conditions under which I would be forced to sell. You typically don't need emergency cash when the market is at an all-time high. You need it when you've lost a source of income and the market is falling. Selling in that environment is not a strategic choice. It's a forced liquidation at depressed prices. It interrupts compounding at the worst possible time. I had about 8% in cash, and even that wasn't as liquid as I thought. In a world of near-zero interest rates, holding cash felt inefficient. Even with high-yield savings accounts paying better rates today, my mindset was still anchored in the past. This focus on returns had obscured the more important concept of optionality. Optionality is the ability to make decisions from a position of strength, not necessity. It's the capacity to navigate a downturn without being forced into a bad decision. By keeping my cash reserves relatively thin, I had limited my options. I recognized this was a strategic error on my part, born from a decade of advice that prioritized growth above all else. That advice wasn't wrong, just incomplete. I had a plan to grow my wealth, but I had an insufficient plan to protect it. The solution, once I identified the problem, was both simple and transformative. I needed to stop viewing my finances as a single engine optimized for returns, and start thinking of them as a series of concentric rings of security. My primary focus had to shift from what will make me the most money to what will make my financial situation more resilient. This was the core insight. Financial positioning is more important than financial returns. Your financial positioning is the structure that allows you to withstand shocks and act on opportunities. It's about building a foundation so solid that a single event can't derail your long-term plan. I'm not positioning for disaster, I'm positioning for flexibility. For me, this meant a disciplined reevaluation of my balance sheet. I broke it down into 4 key pillars of strong positioning. Pillar 1, deep liquidity. This is your innermost ring of security. I concluded that a 6-month emergency fund is a baseline, but in an uncertain economy, a larger reserve is more prudent. My new goal is 12 to 24 months of essential living expenses held in truly liquid, risk-free assets like cash, high-yield savings accounts, and short-term T-bills. This isn't an investment, it's insurance. It provides the time needed to make decisions without pressure. It's the fund that ensures I am never a forced seller of my growth assets. Yes, this creates a cash drag on my portfolio's total return. I now see that as the cost of the insurance premium for durability. If this idea of rethinking your cash reserves resonates with you, or if you're re-examining your own financial setup, consider subscribing. We'll be discussing more of these foundational strategies that go beyond typical investment advice. Pillar 2, debt structure. The second pillar is making your liabilities as predictable as possible. In a higher rate environment, variable rate debt can introduce budget instability. Strong positioning means prioritizing fixed rate, long-term debt. This helps ensure that a rise in interest rates doesn't unexpectedly increase your monthly expenses. Pillar 3, cash flow flexibility. This is the ability to either increase your savings rate or decrease your spending without major disruption. It means not being over-leveraged with lifestyle expenses. When your fixed costs are low relative to your income, you create a natural buffer to absorb financial pressure. This prompted me to review my fixed expenses to distinguish between what was truly essential and what was discretionary. Pillar 4, psychological stability. This is the ultimate benefit of the first 3 pillars. When you know you have deep liquidity, a stable debt structure, and flexible cash flow, you stop making fear-based decisions. Financial anxiety decreases. You can watch the market fall 30%, and while unpleasant, you won't feel pressured to sell at the bottom because you don't need the money for short-term needs. This psychological calm is the critical advantage that allows you to stick to your long-term plan. This is the exact framework I now use to stress test any major financial decision. Before I make a move, I ask, does this strengthen or weaken my positioning? I stopped chasing an extra 1% of return and started focusing on resilience. I sold a portion of my investments, on my own terms, to increase my cash position to my new, higher threshold. Initially, it felt like a step backward, but it was replaced by a sense of control I hadn't felt before. Today, my financial life looks different. My spreadsheets project a slightly lower long-term return due to a larger cash allocation, but I've never felt more secure. It's a different kind of security. Not the fragile confidence of a bull market, but the quiet resilience of a structure built to withstand a storm. For example, we're buying my daughter's car in cash this year. Not because debt is always wrong, but because I value simplicity and flexibility more than squeezing out incremental returns. It's one less variable, one less obligation. That's what positioning looks like in real life. Let's apply this to the mortgage example. The average 30-year mortgage rate is now around 6.09%. Imagine a family bought a $400,000 home with an adjustable rate mortgage, ARM, when rates were low. At a 3% rate, their principal and interest payment would be about $1,686 a month. They felt comfortable, perhaps stretching their budget with the assumption they could refinance before the rate adjusted. Now, fast forward to early 2026, and their rate resets from 3% to 6.09%. Their new monthly principal and interest payment becomes roughly $2,420. That's an increase of $734 every month, or over $8,800 a year. Where does that money come from? For many, it would come directly from funds that would have otherwise gone to savings or investments. If their budget was already tight, it could lead to taking on credit card debt. If a job loss occurred, the margin for error shrinks quickly. This is what poor positioning looks like, a situation where a predictable economic shift creates a major financial strain. Strong positioning, in contrast, would mean that family either had a fixed rate loan from the start or had deep liquidity to absorb the payment shock without stress. They would have the optionality to ride out the higher payments or downsize on their own terms. It all comes back to that core idea: building a structure that prevents you from ever being a forced seller of any asset, whether it's your stocks or your home. So what does this mean for you? It's an encouragement to conduct an honest assessment of your own financial position, looking beyond your investment returns. It means running a stress test with that same question. If my income and the market both took a significant hit, would I be forced to sell my long-term investments to survive? If the answer is yes or maybe, then your primary focus for 2026 shouldn't be finding the next high-growth investment. It's to strengthen your financial positioning. As always, this is not financial advice, but a framework for thinking. First, redefine your emergency fund. Think in terms of endurance. 12 months is a solid goal to work toward. Start building that deeper liquidity reserve. Second, get methodical about your debt. Identify any variable rate liabilities and create a plan to either fix the rate or eliminate the debt. Make your liabilities predictable. Third, analyze your cash flow. Know exactly how much you could reduce your spending in an emergency and how much you could increase your savings rate today. This is the foundational work that enables long-term success. Building wealth is a two-step process. First, you build a durable foundation, and then you build upon it. The mistake I made was focusing so much on the second step that I neglected the first. My journey this year was a lesson in strategy, and it led me to a place of genuine security that is not dependent on market conditions. This is part one of a series I'm calling Financial Positioning Under Stress. In the next video, we'll stress test mortgages and debt structure in a 6% rate environment, because positioning isn't theory, it's math. Now, I'm interested to hear from you. Does this line of thinking resonate? Have you felt a similar need to reevaluate your own financial structure? Share your thoughts and experiences in the comments below. For those who are interested in a more structured, analytical review of their own liquidity and debt positioning, I've opened a structured financial positioning under stress session for those who want a disciplined review of their liquidity and debt structure. Details are in the description. Thank you for watching. If you found this valuable, please give this video a like and subscribe for more content that goes beyond surface-level financial advice. Now go strengthen your position.